So today's source material explores how transitioning to real-time tax compliance infrastructure can unlock hundreds of millions of dollars in working capital just by connecting siloed tax and treasury data.
Yeah, and I have to say that $50 to $500 million of hidden cash hook, that is a brilliant way to grab attention right out of the gate.
Oh, absolutely. It's incredibly strong. But let's just jump straight into the high-level editorial feedback to help the listener really maximize this piece's impact.
Sounds good. Where do you want to start?
Well, the structural transition from fragmented compliance tools to centralized data orchestration requires addressing the human and operational divide between tax and treasury teams.
Why? Because right now, the material brilliantly identifies that compliance and treasury exist in entirely separate conversations, right? Like, they run on completely different systems.
Yeah, but it kind of relies on centralized technology as this magic bullet to solve it all. Which is, it's a gap.
It is a massive gap. The weakness here is that it's ignoring the deeply entrenched operational silos, the historical friction and the different KPIs that actually keep these departments apart.
Because simply installing a centralized data layer, it doesn't guarantee that the tax team is suddenly going to proactively share intelligence with the treasury team.
Exactly. You have to consider why they hoard data in the first place. Tax departments are fundamentally defensive, right? Their mandate is compliance, avoiding audits, mitigating risk.
Right, keeping the company out of trouble.
Yes. Meanwhile, treasury departments are offensive. They're looking at yield, liquidity, funding operations. So they are speaking entirely different languages.
So the suggestion here would be to expand the narrative to include the organizational changes and the aligned incentives necessary to actually implement this bridge.
Exactly. The text needs to show the reader how to unite the actual teams, not just the software systems.
It's like, if we think about this conceptually, it's like buying a state-of-the-art smart home system, right? That's the centralized data architecture. But then you realize the people living in the house flat out refuse to share the Wi-Fi password with each other.
That is a perfect analogy. The technology might be humming in the background, fully capable of doing incredible things, but the departmental culture is actively blocking its utility.
Right. So what does that organizational change actually look like in the text? Because if I'm a CFO reading this, I need a concrete blueprint for forcing that collaboration.
Well, a great concrete example the author could introduce is this concept of a cross-functional working capital council.
Oh, interesting. Like a formal committee?
Yeah, exactly. It's required to oversee the data transition. You bring leaders from both tax and treasury into the exact same room.
But just putting them in a room isn't enough, right? If the VP of tax is still getting their annual bonus solely for zero audit penalties,
Right.
and the treasurer is getting a bonus just for cash forecasting accuracy, they still have zero motivation to help each other. They'll just retreat to their corners the second the meeting ends.
Oh, 100%. The incentive structure is the missing puzzle piece here. So a second concrete example to include would be proposing a shared organizational metric.
Like what?
Something like compliance-driven DSO, or maybe VAT, reclaim of velocity. You tie their performance bonuses together.
Okay, let's unpack the mechanics of that. How does VAT reclaim velocity actually force these two teams to work together?
Well, think about it. VAT reclaim is often this really tedious compliance exercise, right? The tax team processes the paperwork, and eventually the company gets a refund from the government.
Which can take forever.
Exactly. And from a treasury perspective, every day that cash just sits with the government is a day it cannot be used to fund operations.
Or earn interest.
Ah, okay. So if the text advises the reader to tie both departments' bonuses to VAT reclaim velocity, which measures the speed at which compliance data is converted back into liquid cash, it fundamentally changes the psychology.
Oh, wow. Yeah, because now the tax team is financially motivated to process data in a way that actually accelerates Treasury's goals.
Exactly. The centralized software just becomes the tool they both desperately want to use to hit that shared target.
That makes so much sense. Okay, so having addressed the internal teams, we logically need to shift focus outward, which brings up my next point. Overstating the impact of tax-cleared invoices on days sales outstanding risks alienating a sophisticated finance audience who understands the complex, messy realities of B2B transactions.
Yes, The text makes these sweeping claims, right? It asserts that real-time compliance eliminates errors at the root and makes invoices entirely dispute-resistant.
Which is just, I mean, it's a massive weakness. It overlooks a reality that literally every CFO knows. Most invoice disputes in the B2B space are commercial, not administrative.
Oh, absolutely. We're talking about goods damaged in transit or, pricing discrepancies that were negotiated off contract via some email thread.
Right. So claiming that a tax-cleared invoice solves the DSO problem so absolutely, it risks making the piece sound way too much like a vendor pitch.
Completely.
Is there a risk here that focusing solely on this dispute-free nature of a tax-cleared invoice might just completely overlook the reality of the loading dock? Like, what happens when a shipment is just simply missing a pallet?
That is the exact friction point the text is missing. Software cannot find a missing forklift of inventory.
No, it can't.
So the suggestion is to calibrate the argument. Clearly delineate between compliance-driven disputes and commercial disputes.
Acknowledge the limitations, basically.
Yes, because acknowledging what the technology does not solve makes the benefits it actually does provide far more credible.
Right. So how should the author adjust the phrasing then, just to reflect that calibration without ruining the whole point of the architecture?
Well, as a concrete example, they need to tighten up the absolute phrasing. So instead of saying, errors are eliminated before they become disputes, the text should specify that administrative, formatting, and tax classification disputes are entirely eliminated.
Oh, I like that. It's much more precise. By narrowing the claim, the argument paradoxically becomes so much stronger because now it's actually verifiable.
Exactly. It tells the reader, look, we know we can't fix your commercial problems, but we can eradicate the friction caused by bad data.
Right.
And they can take it a step further by including a realistic hypothetical scenario right in the text.
Like what? What would that look like?
They could write something like, while commercial disputes over delivery shortages remain unavoidable, eliminating the 20% of payment delays caused strictly by invalid business partner data instantly shaves days off the DSO.
Okay, let's delve into the mechanics of that 20% for a second. If a business partner's tax ID is formatted incorrectly on an invoice, what actually happens operationally that causes such a massive delay?
So in a typical enterprise, that invoice hits an automated accounts payable system and it's instantly rejected due to the formatting error, right?
Right, it just bounces.
Yeah, it falls into an exception queue. And it might sit in that queue for a week before some analyst finally flags it, sends an email back to the supplier, waits for a corrected invoice, and then finally restarts the 30-day payment clock.
Wow, so it's just a cascading delay.
Exactly. But by implementing real-time tax compliance architecture, the invoice is validated against government databases at the moment of creation.
Oh, so the exception queue is bypassed entirely.
100%. So while the text can't promise to fix the missing pallet, it can absolutely promise to eliminate the 14-day delay caused by a missing digit in a tax ID.
And validating that daily headache really earns the author the right to tell the audience how to fix the broader data friction.
Absolutely.
Which naturally leads the reader to the ultimate intimidating question, right? The compelling vision of a single centralized data orchestration layer demands an acknowledgement of the significant friction and systemic risk involved in its implementation.
Yeah, how does a global enterprise actually build this architecture without completely breaking their current operations?
Exactly. The weakness in the current draft is that it presents this stark binary choice. It's either a fragmented patchwork of local vendors, which is framed as a failure, or it's this glorious centralized data orchestration architecture.
Right, the ultimate goal. But what the material ignores is the massive capital expenditure, the internal IT resistance, and the multi-year timeline required to actually replace legacy enterprise systems.
It leaves the reader totally hanging on the how. I mean, that makes sense conceptually, but could the evidence also support a more cautious approach, where a CFO might read this and say, I love the intelligence, but I simply cannot afford a 5-year rip and replace of my global infrastructure to get it.
That is the exact hesitation, and it's rooted in existential risk to the business.
Right.
Global ERP systems are the central nervous system of an enterprise. They are highly customized, they are incredibly fragile, and they are tied to literally every operational process.
Tearing them out all at once is just a career-risking move.
Exactly.
So the suggestion here is to introduce a transitional roadmap. Acknowledge the phased approach most complex enterprises actually have to take to achieve this continuous financial intelligence.
Without undertaking a catastrophic overnight overhaul. So, if the goal is to give the reader a realistic pathway, what are some concrete examples of that phased roadmap?
A highly effective addition would be a land and expand narrative. The text should advise organizations to start by integrating their top 3 highest volume VAT jurisdictions.
Wait, why restrict it to just 3 initially? Why not do, say, North America and Europe all at once?
It's about proving the working capital return on investment. By focusing on the 3 most complex or highest volume areas, the company can actively unlock a portion of that $50 to $500 million in hidden cash.
Without disrupting the entire global footprint.
Exactly. Once the CFO sees the actual cash yield from those 3 jurisdictions, that newly unlocked capital can literally be used to fund the future phases of the rollout.
Oh, that's smart. It shifts it from a daunting capital expenditure to a self-funding transformation.
Precisely.
Okay, but a phased geographic rollout handles the financial risk. What about the technological risk? Because if an enterprise isn't doing a rip and replace, how do they actually connect their deeply localized legacy tools to this new architecture? It feels a little bit like the tech's still asking them to perform a miracle with duct tape.
Well, to address the tech reality, the author should mention the use of data harmonization middleware.
Middleware? Okay, how does that actually function in this context?
So it acts as a realistic, lower-risk stepping stone. Instead of replacing the legacy systems in year 1, the middleware just sits on top of the fragmented patchwork. It acts as a universal translator.
Okay, so it's pulling the data up?
Yeah. It pulls the disparate data schemas from the old systems, normalizes that data, and then feeds it into the new centralized orchestration layer.
Oh, wow. So it gives the enterprise a taste of that centralized intelligence and reporting capability way before they achieve full native integration.
Exactly. And including this concept shows the reader that the author deeply understands enterprise IT architecture, and not just high-level finance theory.
Right. It makes the whole piece so much more authoritative. So, just to briefly summarize the 3 core actionable takeaways for the listener today. First, address the human silo between tax and treasury by introducing shared organizational structures and KPIs, like that working capital council and VAT reclaim velocity, to ensure teams are actually incentivized to use the data.
Right.
Second, nuance the DSO and dispute-free claims by separating commercial realities from compliance friction, clearly acknowledging the limits of the technology. And third, provide a phased, realistic implementation roadmap, utilizing a land and expand strategy and data harmonization middleware to reduce perceived enterprise risk.
Yeah. These structural adjustments really shift the narrative from a theoretical proposition into a highly credible boardroom-ready strategy.
Absolutely. Well, we warmly invite the listener to revise their material based on these points and submit it back to the critique for a follow-up review. Keep challenging the architecture of your arguments and keep refining the work.